And are we live?
I believe we are live.
Okay. June 5th, 2023, another Prospero weekly update, and another day where tech is higher. It seems like we've been doing this for over a month now, and every single time we come on, tech is higher and higher. So there's always interesting things to talk about in tech, and I think Tesla had some interesting things going on in the Prospero app, right?
Yeah. Tesla right off the bat was very interesting. We wrote in our newsletter that it was well, I want to make sure the meeting's recorded. We actually wrote about Tesla in our newsletter that we saw a pattern of it closing in to the top of our scale at a 100 rating, which the last time we saw back in January when we were pretty heavily recommending it, maybe one of the strongest recommendations we ever made. We're not quite there, but in about a month, it was pretty solidly at the top of our scale. In January, it went up, I think it was January, a little into February, it went up over 70% in that month. So we kind of sounded the alarm on that. It's obviously looking good today. We were talking about it yesterday. That's something that, we love to see that repeat kind of pattern with Prospero. We saw that with Alibaba. Tesla could be the second one that within kind of the span of 4 months for Alibaba. It's about in that range for Tesla. We could basically potentially see the same pattern resulting in the same success rate, maybe even more for Tesla because it was a bigger hit the first time. Hopefully it's another huge hit here. A lot of people are saying, on the technical side that if it got past like 214 today, the next stop was like 235, 240. So we'll stay tuned on that. But the other interesting thing, and we did post it on our Twitter, is that the major news of today was that sales in the Chinese market were bigger than they expected. And it was, I think, a 2% month over month gain. And the interesting thing about that is like the options markets, what we actually saw with Alibaba twice was that it looked like before major news events from the Ant Group, whether it was capital raising or splitting up the company, Prospero, both in net option sentiment with the short-term options markets and upside breakout, downside breakout, looking at the long-term options markets, those seem to move decidedly before the news event. And this could just be another situation where, kind of what seems to happen with these Chinese news events sometimes is that, it's the mix of the kind of totalitarian or, kind of controlled government and capitalist system where maybe some of these people with inside information and very little consequences for using them or leaking them to their friends, whether they're invested in American hedge funds or Chinese ones. You could see how that could be something that we could be picking up because it's kind of different in the US where it's even if there's information, you get wind of what a company's doing, maybe some legislation. I'm not going to say that doesn't happen, but it's definitely harder to keep that information in a smaller group. And it would be great if we could kind of see that consistently. I'm actually even more excited that it looks like we picked up the same pattern with Tesla twice. After knowing that the second time might be another thing that's kind of related to the Alibaba situation, where it looks like our option sentiment numbers, whether it be upside breakout that contains, a lot of option sentiment or net option sentiment, are kind of picking up these bets before they're reflected in the stock price.
Do you think when Tesla releases full self-driving, it would be a ChatGPT moment where the stock would react quickly to that being seen by the public and investors?
That's hard, and we kind of get into these value investing questions sometimes, and that's what makes it so hard to price tech, like we were talking about last week. Like, I don't know, and I don't think anyone knows how much of kind of just like the assumption that they have those capabilities or they're close to those capabilities is priced into the stock already. I think something that would make it absolutely explode is kind of more evidence that self-driving cars would be further on the road, because I think they're there, and I think that that's the big unknown. No matter where the technology is, it's kind of hard to know if they're going to actually use it and when they're going to actually use it. And so you can't really see like the big revenues that you could project from that. But obviously that's going to be huge from them. That's kind of like an MRR or an ARR situation where everybody loves. That's very hot with tech, whatever kind of tech it is. People want to see that kind of situation. There's also, when we talked about this a little bit in our newsletter as well, there's a lithium shortage, and the price of batteries is going to go up. So that's another, like, I think, short-term catalyst that could be seen with Tesla. Now, for someone that needs to be consistently buying so much versus maybe sitting on like a stockpile of batteries because the demand is so high, I don't know if we'll see the same kind of lift as we expect with like ENVX. But yeah, I think it's those things are definitely things to watch. But like, yeah, part of me says, like, of course, any big news with Tesla, the market's going to react. You're going to get the momentum investors, and of course, that's there. But we don't know if just like the news, and it's kind of even hard for me to think of like a news event that specifically would kind of take them that much closer without knowing they were going to get on the road, because everybody kind of knows they have those capabilities. They're obviously testing them on the highway. A lot of what a lot of people don't necessarily know about self-driving cars, and like with any algorithm and any AI or what have you, is things like image recognition have been close to like 100% for a while now, and there was a lot of competitions around that. So kind of the nuts and bolts of what it would take to run a car, and like obviously the geospatial things, slamming on the brakes, all of those mechanisms I would say are in place already. The big question is, when it's going to be allowed to an extent that they could really start collecting revenue on it. And clarity on that, I think, would go a lot further than, I don't really know what they're going to announce that could bring it further. And I think the other really important thing that needs to be said here is there's a real chicken or an egg problem with this stuff, which is, until that training set is a lot bigger, there's going to be errors in any training set, especially when you send a car into a situation that it doesn't understand. No matter how well a car might be able to identify like an image of a person, an image of a bird, an image of a kid, who might move differently. It's hard to know when all of that data is going to, no matter how many simulations you run, there's always going to be situations where a model is wrong, no matter how accurate something like image classification is. And I think that's tough, because as long as we see, and we've seen them hit people, we've seen robots kind of have these errors, and as long as that exists, it's going to be kind of hard to get the critical mass of training data. You need to fix the problem, or you need to make it more reliable. So that does become a bit of a chicken or an egg, where it's like, how do they get the training data if they're not like kind of let loose enough? And I think that process is slow. But I kind of look at it like this: the rates at which they will have to be, almost kind of perfect on this stuff, I would say is going to be hard, kind of with this trickle along strategy, without like opening it up and saying, when you're building a new technology, when you're training a new model, like I don't want to be flippant about human life at all, but a lot of people die on the road now, and a lot less people would die on the road if robots were running things. I think pretty much everyone can agree on that. So I'm not trying to be flippant about like maybe a few people, being, facing damages on the way to that. But the real problem is even in the legislation. And this is something that gets discussed all the time in AI. Like, who's responsible? Is it the company? Is it the programmers that kind of worked, or the fail safes, or like, where does the, obviously it starts at the top at the company, but where it's just like, if someone's darting across the street, kind of where traffic law even is difficult amongst humans, it might be something that I just don't think people are in courts are really ready to solve yet, if something does happen. And I think that's one of the major obstacles. And another thing is just that, there's people like in my parents' generation, my mom was like, I will never get behind a self-driving car. I want to drive. And And it's kind of the only thing that works if like the majority of people buy in, or kind of everyone. So either you're going to have to be forced to do that. And like if we saw anything about like masks, or, how like forcing Americans to do anything goes, like I'm not sure when we actually see self-driving cars, despite the fact that I think like if they just widen the mandate, um, like, there would be far less accidents, far less deaths like on the road, like in aggregate, I would say within a year, as you transition. So practically it makes sense, but I don't know when we're gonna get over that hump. But one thing I will say, Elon Musk is the only one that figured out how to sell cars directly to people. Like, I think I want to say ever, I'm not sure, like I'm sure maybe back, but for a long time, he worked around that system. So if anyone can pull it off, like I would say he could. So that's the other side. But it's just like, that's why I think Tesla is, one of my favorite stocks to own long term, because like it's just something that like it's a technology company in terms of the batteries, the AI, it's a great design. They're kind of like fringy, like Apple, like that. There's so many things that they do really, really well. But then there's something that it's just like, if that becomes real, both with their exposure in like the trucks and they have exposure everywhere. That's something that like the day that becomes more practical, you might see Tesla's stock price like 10x, maybe
Wow.
not that day, but like, but yeah, like if there's news that breaks that like, hey, like a couple states are willing to try in metropolitan areas, and that's the kind of thing like Cruise is doing in San Francisco, and they're having these test runs. And yeah, the second there's like major news, like even if you see it with the marijuana stocks, basically you see like sometimes there's like even like whispers that like the US is getting ready to pass some new legislation or something like that, and it just rocketed them even before it happened. So we might see it kind of bleed a little more slowly with Tesla there. But yeah, that's why it's like it's very hard to handicap when and if that might happen. I'm not sure. It's just like advances in AI for them. But yeah, when and if that becomes a clearer story about when they can really start collecting monthly revenues from those self-driving subscriptions, huge. It's going to be huge for them. That's why it's one of the things that's going to be in my long portfolio until further notice.
And it's crazy. We talked for so long, and we didn't even mention the Cybertruck, which it's now the 6th month of the year, and I believe they said it's going to be out this year. So that would be either next quarter or the quarter after. So that should be another bullish thing for Tesla coming up very soon.
I think again that's a bit fuzzier because you don't know how much of those sales are you don't know how much of those sales are built in, and it's not priced like a car company. It's priced, like I said, more like a tech battery, like all that stuff, and they're great in that. So like that makes it even harder. Even if they were just an EV company, like you could kind of back into like those sales numbers a little more, but so much of their like growth multiple is in these other related businesses, and they're big battery factories and everything like that. So it's just like it's hard to say. But what isn't hard to say, and like back to like one of the reasons I love the stock and one of the reasons I'm excited that it's like fixated near the top of net option sentiment again, is that any of these news events and any progress that they make in any of these areas, or even just like a more bullish AI, which they're tangential to batteries, the lithium shortage, there's all these things that like once the news breaks and then the momentum retail traders get a hold of it, like things get out of control with Tesla very quickly. So it's probably one of 5 longs that I would say needs to be in your portfolio, and maybe just I'll name my other ones as of today, because Amazon just dropped out. And that was my favorite one, but it went down from 88 upside breakout to 45 upside breakout last week. And I think that actually has to do, it was a little prescient, the conversation we had last week. We might want to tie those clips together with dates. But like we were basically talking about how Amazon could be hit more as a retail company, as people get more worried about this kind of like recession that affects like individuals more than it affects like tech and AI and that kind of thing. So I would say my other clear longs now are Meta. We all know how much Prospero and I love Meta. And the big thing that I even talked about a bit in my newsletter this week was that my thesis on Meta is that it got hammered way too hard relative to what it earned, based on some bad decisions by Zuckerberg and people just basically pricing him pissing away money into the metaverse. But talk about a huge, like, kind of cataclysmic shift, switching from this business in the metaverse that, it still is interesting, but it's fallen a lot from where he put a massive, probably far too big of an investment. And I would just like say that one of the things that's important anytime you're valuing a company is that a company like Meta should not be doing R&D unless they're consistently good at R&D. And they haven't really proved to be good at that. A lot of their big growth has come from like acquiring Instagram, acquiring WhatsApp, just like acquiring these user bases. So they should kind of know better than to just be like going on R&D expeditions. And most mature companies do know better. So that was kind of a surprise, and they did get punished for it. But now they're in a very understandable R&D wheelhouse for them, where Jan LeCun is one of the foremost, AI experts in the world, one of the most respected guys, right up there, I'd say, with like Jeffrey Hinton, the guy who just left DeepMind. And one of the things that I think is very important for people that may not understand machine learning as much, or AI, is like the training set is so important. And, I would say right after OpenAI, that has building this great, like, kind of interactive data set of like conversations, so they get better at answers as people feed in data. Anytime you put in your company's business plan, or like your HR policies to have it spit out something, it's learning about all that stuff and how to talk about it. So that is, like, I would say, probably the strongest data set. But Facebook could catch up really quick, Meta, whatever you want to call it, because they have everybody's conversations already. They have all these personal conversations with WhatsApp too. They have, which a generative AI could learn to mimic, and OpenAI didn't necessarily start with that personal data. And then you have all these interactions. You have what people post about. Like, you have a lot of their work and personal lives already too. So they have, like, one of the best, I would say, training sets, and a good team. So that's when I say, like, when I'm still bullish on Meta, and when Prospero is still bullish on Meta, like right at the top of our upside breakout scale, I think that's a big part of it, that I do think they can win more from generative AI than people might be seeing. Now, it looks like you want to jump in. I have some more longs to get into, but
Yeah, I'm fighting with this tree. Guy's getting his tree cut right across the street from me, so I
I
can't. You don't hear it at all?
no, I don't hear it at all.
Okay, cool.
Um,
I just wanted to mention that you talked about Amazon a little bit and how their net options went down, and they announced that they're going to possibly deliver free telecom service to their Prime members last week. So maybe that is something that the market didn't really like. I know that the telecom stocks themselves, they did not react well to Amazon getting in their industry, and I think we saw some of it in Prospero.
Yeah, no, I mean, I think that could be a major part in maybe people getting wind of that deal, like, to explain we don't necessarily see such a drop. And I think that, like, yeah, it makes complete rational sense to me that maybe they thought off the news. That's why net option sentiment kind of stayed higher, but upside breakout went down. I could see people basically looking like this might, in like 2-3 years down the line, and this is kind of where Amazon always is at, that might be huge for them. But in the short term, that's definitely going to cut into their profitability. And if you look at them, like, compared to Meta, like, already their profitability forecast before, kind of like however they build in the spending on this new business unit, is at a 58, I believe. It might have even been lower, versus Meta that's at like an 82. So that gives you a good idea. And they're both kind of similar in growth projections. So that just tells you Meta can just make a lot more than them, as they're kind of growing at a similar rate. So yeah, I think that is I think that's a big thing to kind of round out a few of the other top fives we have. I think CELH is a big one. We saw it up again. That's been in our long-term things for a while. I just think they have a great opportunity to grow. They have a solid product, a lot more call options in the long-term options markets in the short term. They always are, then put options in the long term. Short term, net option sentiment looks solid through and through. That's one we have and continue to really like. ASML we mentioned last week. We kind of went through that for a long time, but I think that's one that already had very high profitability as a semiconductor, and I think they're going to have higher growth in their updated forecast that I think is going to take them a lot higher. And then I'd say for the fifth one, it's kind of a tough call. It's less clear. But First Solar has been something that's strong for us. Obviously, it's a growth market. I kind of like to diversify a little bit, but stay in tech. Great profitability and growth from that. Still really good upside to downside breakout ratio. We haven't seen the non-option sentiment as high, so that might be one where you keep an eye for a buying opportunity when you see that non-option sentiment rise. But I think that kind of rounds out our top 5 longs.
Awesome. And I mean, Apple's not a company that you mentioned in the top five, but they're a powerhouse. And they should be announcing, I think today, that they might be releasing a new VR headset, which I don't know how bullish you want to get behind it. Like, I was watching CNBC and they were talking about how it's the biggest product launch for them in 13 years. But Apple's run a lot, and I feel like it kind of be a sell the news type of event. So with with Apple set to release this announcement in their big meeting today, how do you feel about it? And I feel like it could kind of be a sell the news.
Yeah, I kind of wanted to like take a look at Apple. And yeah, I think like in talking about it compared to I think the big difference here is like Meta, like compared to Meta, for example, and how you think about like our top 5. Like Meta, we mentioned, is like I think in the 50s in growth and 82 in profitability. Apple's at a 46 in growth and a 66 in profitability, and doesn't have as good of an upside breakout to downside breakout ratio. So I think that's just to me, that's just kind of like it just loses out to something like Meta or something like CELH that we're going to get more growth from. Like 46 growth is just not enough for me to say that, like, because like we talk about with tech, like we don't know how much of the growth is built into the stock, and like chances are greater, however much you want to say about that, chances are greater that if the growth is lower, that more of that growth is built into the stock. Unless there's some like new product or something that you really think is going to allow them to beat that. And I don't doubt that something like a VR headset could really grow them down the line, but it's kind of back to the same thing we talked about with Amazon, where it's just like Apple's at 66 profitability and 46 growth. So if you eat into those profits more and maybe the money isn't even used as well for growth operations, which they would need to like look as good as some of these other names that I mentioned as our favorite longs, it's kind of not, when you kind of go through all those levers, it's not an attractive case for them to be doing these massive VR projects. Like, this is a bit of a more advanced trading tactic. But whether it's options or whether it's looking at just buys, I kind of like to look at, for something like that, a limit buy, where basically you're just looking for a certain entry on it. And I think that that can kind of, and just like a good till canceled, that can kind of take care of like upwards movements where you're just like, hey, if there's some big announcement, I'm just ready to buy like $5 above 5% above where it's trading, and you're just basically constantly looking for that momentum. Maybe you move it up if it's a slower trickle and you're not convinced and there's other tech names you're more excited about. But that's how I look at something like Apple, even if I'm going to trade it. Again, when I see things like Meta performing so well, and Tesla right now that we love, like obviously, I mean, just to like go with Tesla as well, like, we kind of talked about it by the same dynamics, and it's got a 61 profitability and a 73 growth. So that's a very interesting contrast with Apple, where they're in a very similar profitability spot, actually. But Tesla is just going to grow, 30 points more in our scale, and that's moving even more towards the top of our bell curve. So it's kind of even bigger than the raw point thing, which is how we, which is how we get there. So yeah, like Apple, it's not that I don't like it. I would say like when you're moving more into like 10, 15 stocks that you're long, no, like Apple is on that list for me. But we like to condense it a little smaller, because my feeling philosophically is if you're going to go invest in single stocks versus an index, you really want to keep it to a tight, maybe 5, maybe 8. Otherwise you might as well just invest in the index, because eventually you are investing, very similarly to the index in terms of the upside you're going to get from those stocks, and you're probably taking on a lot more risk.
And so Apple is not trading cheap based on valuation. I believe their PE just crossed 30. So how would you explain it continually moving up? Is it a safety trade because their profits and their cash flow is so well known?
Yeah, I think Apple is just like something like, and I think like it's kind of what I'm talking about, where like you have diversified investors, that it's just like, Apple's a great, um, Apple's a great kind of tech company that you don't necessarily like. It's just the hardware exposure is very different, and like there's tons of software plays, but there are very few hardware plays that are as tried and true as Apple. And if you're just thinking about good diversification, especially as we kind of talked about heading into the economy and like what's going to happen, and especially how AI is gonna play into it. Obviously, Apple's moving into streaming. I think they're doing a decent job of that. Apple just like, I'd say because of their design principles, it's kind of very different than when we talk about Amazon. And it's much more of like, oh, they actually are just very good at entering new markets. They have a process, they have a system. Um, but I would say Apple, it's more of just like they know how to make attractive designs and products, however much that is. They're not necessarily moving into as many things and can grow as fast as Amazon, based on like, I would say Amazon's just ability to do that well. Um, but you look at Google, who like has had so many failed products. Apple has had like a short list, but generally when they get into something, they do it well. And I would say they have a higher hit rate than Amazon. Amazon is just like so good at growing fast and chopping off things that don't work. Apple is much more like thoughtful, I would say.
And so in your Prospero weekly newsletter yesterday, you said you're bullish with a few caveats. And last Friday, we got a very strong jobs number in 339,000 jobs added. And for a while in the market, it seemed like good news was bad news and bad news was good news. But now this is good news and the market reacted positively. So are we switching up our tune in the markets?
Yeah, it's really, really interesting. I don't like, I think, the big thing is kind of that AI theme that we're talking about, where I think more people are kind of thinking about the difference between like tech and them being bullish on it long term because of these advances. Um, that they don't really have a case to not be bullish on it, regardless of like, what they think is happening with rates. I think the market is reacting as if that like that might be noise to the growth of these like tech companies that are ready to take a big step forward, because technology is taking a big step forward. Um, but yeah, I would say the other thing is something that I was reading about in the Wall Street Journal today, which is GDP, um, seeing growth there, but GDI, which is income, not matching, and actually seeing jobs and job hours declining, even as GDP rises. So it might be the case that I don't know. I'm not going to say they're juicing those jobs numbers. I'm not going to speculate on potentially juicing GDP to just sell a healthier economy. But regardless of juicing on the other side, like we could be thinking that seeing this GDI number go down, that the market is thinking that Powell will have seen enough in terms of just like maybe the overall, like because more specifically, Powell, when he talks about jobs, he's actually most concerned with inflation becoming stickier because of kind of these you want to say, I would say, especially like, higher paying jobs, or even like the stock market driving up and kind of giving people more liquidity, things like that, that kind of like cause this, or corporate profits, whatever it be. But I think for him, he just wants to make sure that the economy is like getting enough of a hit and enough of a downturn that he's not just pushing the interest rate raises down the line. I mean, I think the last thing he wants is to stop raising rates and then have to raise them again. So I think he wants to be totally sure. I'm guessing we're going to get one more that may or may not have a big effect on the market, because the market might be accepting that we can handle that at this point. But I think that GDI number is something to keep an eye on. And I'd say the converse there is that, we might be, even with that strong jobs number, with things like, hours, wages, like, and income overall going down, that might be enough for him to say, okay, these are working. Because the other thing he says all the time is these take a while to, fully impact. So he might just think that we've seen enough, we're starting to see a downturn, and he doesn't want to kill the chances of like the soft landing that I think he wanted. He kind of backed off for a little bit, but I think that's still, what I would consider optimal for him. I think he'd love to come out of this like on, even if the inflation numbers are not where he wants them, on a steady path down for inflation, where he's showing the market not getting hit as much as he could and kind of like threading that needle. But yeah, I think it's going to be very interesting. And obviously, like, the Fed is reactive. So a lot of this is based on inflation. And I think as long as we see inflation continue to trend down, or inflation growth, we should say, I think we'll see we'll see maybe one more increase, if that. But I think if we get I think we were at 4.9 last time. I think if we get down to 4.7, we kind of keep that pace, it's something that, even with these strong jobs, I would expect him to stop the rate increases.
I like when you mention how it's not that inflation is actually going negative, it's just that the growth is going down. And most likely all the inflation that we've seen over the past 2 years is ingrained in the system and it'll be around forever.
Right. I mean, it could be, well, again, like, I think some of that is like, as he says, and I pointed out, I think some of it is going to keep, these increases are going to keep rippling out. But yeah, I don't disagree with you that I don't think we're going to get down. I think we might be, what I think they say, 2% is what they want to get to. I think we might still be at 3, a year, 2 years from now.
So if you take a tally of the situation and inflation is relatively high to where it's been, rates are high, job growth is supposedly strong, but income is not matching. Are we in stagflation?
I don't think so yet. Some people think we're going there. But I think we just need to, I think we really need to see if inflation is going down. And I just think that, I think if it's not, if there's a disappointing number there, I think the market is going to react poorly, and we might get, like, I think what it was, I forgot. I think it was Goldman Sachs. It was like a big bank. I forgot. I talked about it in my newsletter a few weeks ago. That said we might get 2 to 4 more increases. And I think they're probably leaving room for that. But they said probably closer to 2 was their estimate. But yeah, like I'm saying, we might, with tech carrying us. And I'd say just because it was hit so hard. And we still have like a lot of names, like obviously the big names have come up, but I think there'll be a lot of trailers like cloud providers, security providers that didn't come in the first wave that are going to kind of be like, oh, well, if these big businesses are growing, the support businesses are going to grow too. And I think that might carry us. A lot of people are talking about the IWM being the next great thing to get, because then I think we talked about in one of our first lives that the IWM traditionally gets big gains after the big companies have sort of done that. And I think that ties in very well to what we're talking about here. So if you index invest, I think the IWM is a really interesting thing to look at right now. But yeah, I think that's where I'm looking at the macro picture.
And just a few months ago, the market was pricing in rate cuts this year, and now you're talking about possibly 2 to 4 rate hikes. So how has that not affected the markets more?
Yeah, I mean, I think part of it is like what they were expecting, and I think they were expecting um not expecting this AI boom, I would say that like that's probably the big difference. Is I think that like what I'm saying, I think that's carrying the market up a lot more, and people are just like bullish and might be bullish through, some more rate increases than we thought. Just because they see those big companies and the ones that are kind of in that ecosystem as, value based on how much they're going to grow with the rise of tech. And I think that, yeah, I think that's a big part of it, and a big increase. And like, yeah, it's like what we talked about last week, where three of the 500 companies, Meta, Amazon, and Nvidia, turned what would have been a negative 0.37% week for the S&P 500 to a 0.33% positive. And I think that that's just the perfect example of what we could see, where it's just like, yeah, the market is going to react to those things happening, but it might be carried by, I would say two things, both like this big tech boom that everybody's acknowledging is real now. I would say there's very little dispute about that. How real, and like I've heard it called it a dot-com bubble, which is really dumb, because dot-com bubbles, you had something like pets.com that wasn't even a real company, and they didn't get to a point where they had a real business model, which is very different than a company like Google or Microsoft or Amazon just having this huge new business unit like that. Yeah, it might not be all the way worked out with the revenue, but I think what a lot of people don't realize is like there could be a lot of job reduction that's being priced in, not just the revenue, that's coming in to profitability, especially for those big guys with the most advanced tech, which is who we're talking about. And then the other thing in terms of like that, I think a lot of people that don't understand, where AI has come from as well as I do. And, for those that don't know, I worked at AI as a service 12 years ago. I started my first company when I was 25. I'm 37 now. We have made joint invention patents that we still use with NYU. We were one of the earliest people to the game, us and NYU, my last company. So I've been around it for a long time. And I've watched it grow. And one of the things that made me say, I don't want to be an AI as a service anymore, is Google announced their Auto ML product. And I was like, okay, I can never build. There's no way I can compete with them on technology. So let me find a new niche and let me find a way to help people like I do with Prospero. Those were kind of the search parameters for the new business, and being able to use the same formulas I sold to institutions and just give them away to people for free, to be their partners in kind of this data sharing, where we can create unique alpha amongst our user base, and then be able to drive that instead of selling it to institutions, putting that in products for them, and eventually investing, their money, or creating a high yield savings account where they could access the kind of rates that their unique data is allowing us to generate, in terms of the alpha that we can get, and we just pass that on to them in a savings account, better than they can get anywhere else, where they don't have to assume the risk. But that was a small tangent. Where I would say that some people don't understand, like AI already exists and like the revenue streams, is like the cloud providers. And I think this is why you saw like a lot of them, and associated businesses with the cloud, and even like Supermicro, who we've talked about, that is just like a different version of that, like more kind of specialized to these high performance computing problems. Also shoot up, where it's just like AI is embedded in a lot of those products. And Google, when I'm on Google Cloud, they have a lot of really cool like stuff for app and Firebase, and even before generative AI was a thing, they were rolling out a lot of products that made things a lot more easy. So when people say like, oh, we don't know the revenue, it tells me like, yeah, like sure, like not all of it. But those businesses exist already. It's not like they're creating AI businesses from scratch. They already know how to integrate it into products. And it's not just like everybody's going to sell chat GPT. These big companies are going to integrate these kind of more advanced, whether it be conversational or decision-making or what have you, AIs into their products. And it's easy to see how they'll grow revenue. And I think that's what we're seeing.
So if I were to give you these two scenarios for the December 2023, the end of this year, the S&P 500 hits a new all-time high or new all-time low, which would shock you more? Not all-time
Um,
of this cycle.
I think the all-time low would shock me. I mean, it could be the all-time low. It's like it could go down to like, yeah. I mean, that's just the numbers on that. If you were talking about, I think the more interesting question is probably like, would I be more surprised to see it go up 20% or down 20%? And that's a much tougher question in light of the macro circumstances. I would say that like I'd lean more towards down 20%, just because I do think we're going to go on a little run here, like a 6-month run. But then I think that might be followed by some of this big recession stuff, the consumer spending, and then I think we might go back down and maybe back down bigger. It's hard to say right now without all those variables. So yeah, like I see both an up and down scenario, like for that, like, so it's hard for me to just ignore that down scenario and say just up. Because I see them both existing, and we might get more down and then up, or like it could go, but I don't think there's enough downward pressure relief in terms of like what could play out in the credit markets, like we keep talking about, and personal finance just going through the roof. Obviously that affects real estate markets and just general credit tightening. And the people that I know in credit and banking say that like the First Republic, Signature, like all those banks, that's not fully worked out yet. Obviously we've stopped the bleeding, but the tightening of the credit markets from like, what we've kind of seen is coming. And like, honestly, when you see kind of an increase in personal credit, one of the things that actually makes the bubble burst is tightening credit markets, because a lot of the people are just getting new credit cards and whatever they can until like their avenues to do that dry up. And then all of a sudden they can't pay their bills, or they can't pay the mounting credit card debt they had before. And that's when you really start to get a big collapse. And so, yeah, like what I could see in a weird scenario that I would consider more likely than the S&P being up 20% or down 20%. I would say something more along the lines of QQQ up 5% and SPY down 5%. So like a 10% differential, but we basically see like a difference between the haves and the have-nots here.
So how would the history books define this period then? Would we have a bear market and then a 2023 bull market and then or is it all just one bear market if we go lower, like starting the beginning of next year or the end of this year?
Well, yeah. I mean, I think let's check. I do want to see like our current um I do want to see year to date where we're at for the S&P. Yeah. So that's another thing that's interesting. We're up about 12.64% year to date. So obviously if it swung down 20% from here, we would have 2 bear markets in a row, and that's really, really rare. So that might be something else in favor of that, which is why, off the cuff, I kind of said maybe down 5%, up 5% makes more sense, because that would still be a bull year. But yeah, I could easily see a bull 2023 and a bear 2024. But yeah, like I think now through the end of 2024, it's hard for me to see QQQ not being up over that time in the green. And I could easily see SPY being in the red. And that's two reasons. The first is tech got hammered a lot harder, and always does in rising rate environments, versus the tried and trues and the high profitability, lower growth stocks. So there's two things, like tech has more room to go up, and there's a legitimate business reason for it to go up, which is why it's really hard for me to envision something that a scenario where we don't see QQQ at the end of 2024 from here up.
And the presidential cycle will really start kicking off probably the end of this year. So how does that affect the markets usually? Does that calm the markets, make more volatility? Does it even affect the market?
At the end of the day, I think that both political parties are like pro Wall Street enough, and that's the one thing being on Wall Street for a long time. I think the classic example there is like Renaissance Technologies, where Jim Simons is a very famous Democrat, and then you have Robert Mercer, like, who funded Cambridge Analytica and is like obviously on the complete other end of the spectrum. And that is to point out that, like, even in finance, you could have, like, even in one firm, you could have people that are like putting aside their politics, are going to be funding their sides. And I think that, yeah, that is one very interesting thing about Wall Street, where it's just like the very goal oriented, very you just get your work done, that's all that matters, you perform. And I would say it's not a meritocracy. But I would say that makes it kind of more of a meritocracy than a lot of industries, I would say. But so I don't think pro Wall Street stuff is going to happen regardless. I think what is to watch is, like, obviously certain industries, like, if it looks like it's leaning more Democrat, I would say, things like renewable energy are much better bets. And if it's going to go more Republican, I would say things like, they lean more towards, certain kinds of, obviously other energy. Energy is like the biggest example of where you could go divergent, and you might make bets based on, if there's a clear winner, you might start seeing bets in those directions. But I would say what makes it tough, and maybe even tougher than a lot of things, is traditionally, you don't get the kind of unification, Democrat and Republican unification, on, like, spending bills for, I would say, subsidizing non oil companies. But chips, they really came together. There's, like, I think Republicans view that as like national security, and Democrats just obviously like to support US businesses growing, and I think that tech, they're traditionally more supportive of than Republicans. But that is something that we saw unite. And so, yeah, like, I think that also becomes a very hard thing to kind of odds make. But yeah, I would see energy start to diverge if there's a clear winner. And then there's just, like, depending on how much, like, election fraud, like concerns are bubbling up, you might just get, like, a general hedging and bearishness in the market, which is completely logical. But that's how I'd look at it.
Who is your all-time favorite investor and the person who inspired you maybe to get into finance and learn more about finance?
Oh, I mean, my first boss was Bruce Greenwald, and he's a pretty famous value investor. And I would say value investing was something that I was always interested in. I was always interested in Warren Buffett, and his process. So I would say that's one of my inspirations. And then kind of Ray Dalio on the other side. Kind of, that's my early career, learning a lot of value investing. But then I would say a lot of the stuff that we've done with Prospero is kind of a lot of the organization of formulas that he was famous for at Bridgewater, and kind of taking good qualitative ideas and turning them into process and numbers and formulas. And obviously, I've evolved my formulas. I've been working on my stock models for 8 years. The option sentiment thing that works really well, like specifically, like one of my main tasks for 4 years. And I think that's like a very similar Dalio process. But I would say underlying all of that is it's got to make value sense. And I'm like, a lot of what I'm doing, especially when you look at like upside breakout, a lot of what makes upside breakout, which contains a lot of option sentiment, different than the pure option sentiment, is I'm looking at a lot of value, where it's price, things like that, that are definitely governing that as well.
Do you have some books for people who want to learn more about finance? What are your favorite books you've read?
Well, Ray Dalio principles for anyone. Like I've said fooled by randomness, but Taleb is great. Black Swan is really, really good. I think that's a fooled by randomness we talked about last week, but it's more about just like understanding if you have a process that's working versus luck. And then Black Swan is kind of a great complement to that, where it's talking about like, a lot of people think it's about the Black Swan events, but really what it's about is that you can't predict these events. And the best thing that you can do is not try to, not say like, oh, I better watch out for this specific thing, because like, if you know the gambling term, the field is almost always the Black Swan event versus like any even number of Black Swan events that you're trying to put your finger on. And then the other important thing about Black Swans is like hedging, which I say is important for everyone. And we just released our first model portfolio for Prospero, because I'm feeling good about the next 6 months. So I put a lot of growth stocks in there for the first time, but it was still 2-to-1 long short, and I put 12 longs and 6 shorts. And I just think that it's just like, no matter how sure you are about the direction, like at least do something 2-to-1 like that, or 3-to-1. But like, it's not very smart. Especially if you can say, hey, I think these are losers, and hey, I think these are winners. You really cover yourself a lot, because if you pick good losers, and the market is just down, you could have like, obviously your winners be flat overall and get your profits on just like a down market, carrying those losers a lot further down.
So before we end here, I have one more question. So we talk all about picking like individual stocks, which is what Prospero was built for. It gives you the best insights on them. If you're an investor and you don't want to be that risky, would you suggest people buying ETFs, or what is your thoughts on that?
I mean, I think it's all about like your risk level and your comfort zone, and your, how much you want to learn. Those are all important levers. Like I would not, unless someone has like, I'd say at least um a couple hours a week, maybe closer to like, 4 a month, I would say is probably good if you can do that consistently. Unless you have that, I would recommend an index. I would recommend something like, Vanguard Total Return. I also like international real estate, or currency, to kind of balance that out. And or I kind of recommend 5%, 5 to 10% of crypto assets. I actually really like Block, BLOK, because that's a nice diversified, like not only like kind of blockchain more so than crypto, but obviously there's some crypto miners and everything in there. I think that's a good one. But the other side of that is, I would also recommend, like, even if you put 90% of your portfolio in, like, let's say like 80% total return, let's say 7.5% international real estate ETF, 7.5% international currency, to obviously hedge against the US stock market, those two, and then let's call it 5% block. That sounds like a great ratio to me for just like ETFs and like diversifying upside and risk management. But then I wouldn't really leave out, I wouldn't really leave out the ability to maybe say, okay, instead of doing 70% total return, do the same things, I recommended, and then just learn with the other 10% on single stocks, because I do think that it is, clever, having that, let's call it 90% of your portfolio that's like internationally hedged, like the whole market return, where you're making interesting plays that you think are high upside and you like their businesses and you're just tinkering with that. I think it's an essential part of learning if you have, let's call it an hour a week to dedicate like that. Long term, there's nothing bigger for, your personal wealth and growing it than, figuring out how to, invest in stocks. Because we're all, most people are on, a certain income, they're saving for retirement, a lot of people have families, getting smarter about taking on risk in the right ways and doing things like hedging, or even just like putting stops on your trades where you have like high upside gainers. All of that is just like, you will grow your wealth better if you learn and do the right process. And, as we always emphasize, process and learning what is like good risk adjusted bets on companies that you think the market is underestimating, versus YOLOing stocks, which is just like, people that want to gamble.
That's great advice. And this was a great conversation. And I'm feeling good about next Monday. I think we're going to get 10 viewers at one time next Monday. I'm feeling good. June
Should
12th.
we breeze should we breeze through quickly the telecom things we were going to talk about?
Yeah. Yeah.
Because I do want to say that, and I did think it was interesting.
Okay. Yeah,
We
sure.
obviously saw AT&T and T-Mobile like at the end of the week take some big losses. Um, and just as something to look at, like especially like Amazon we talked about earlier was kind of scary news that to AT&T and T-Mobile, and that's why they're going down. But we could actually see before that news, from the 24th to the 1st, downside breakout for AT&T went up from 44 to 57, and upside the 24th to the 1st went down from 70 to 60. So that's a really good hint. That's a pretty good delta. And especially if you see downside breakout in a clear downward, in a clear upward pattern, and upside breakout in a clear downward pattern, that's a really good indication and a great warning, especially if you own those stocks. And it's always worth, like, I would say checking once a day your portfolio in Prospero. It really can't hurt. And sometimes, even long-term stocks can change the dynamics on news like this. And it reinforces it even more when you look at T-Mobile. And from the 23rd of May, it was 54 upside breakout. And by the 1st, it was down to 38. And then downside breakout went from 28 on the 23rd to 44 on the 1st. So those are like, maybe even bigger moves for T-Mobile. And that's the kind of thing where, like, okay, you can really up your game in terms of like your risk management and seeing these events happen before they occur. If you can kind of really like say, oh, AT&T is going down in a downward trend, like, wow, I wonder if something's going on. Maybe I should check T-Mobile. And if you see a similar trend, that's what Prospero is for, because that's enough of an indication to me, if you did your homework there, to say, like, I'm not quite sure what's going to happen to telecom soon, but it's not good with both of these stocks in clear upswings and downside breakout, and downswings and upside breakout. And just one thing that, if I think if you're making a short form video, that's pretty important here is if you look at basically, we looked at the halted stocks when there was a bunch of bank halts, and we actually looked at it a week before the halt. And all 4 of them have nearly identical charts in terms of spiking downside breakout. And what's really interesting is basically, like, all of those institutions that kind of saw this coming through the pipe, that saw the bank trouble, like, they didn't even want to buy a bunch of short-term options and drive down that option sentiment, because a lot of people, especially retail investors, look at those short-term expirations, so options expirations. So they kind of hid their plans in long-term options, even though they knew it was going to be a short-term play. And this is the kind of thing that Prospero just like really helps you with, and exactly what we're talking about here. If something on your watch list is going down, especially if you're seeing that downside breakout go up and the upside breakout go down in clear patterns, if you're seeing that, like, like we say in a bank stock, check some others, see if the pattern repeats. And if it does, I would get the hell out of that, vertical or that industry or that subgroup until you have more information, or put stop losses on. That would be my recommendation.
And that's amazing because you don't even need to know why, because the money talks. You're seeing what people are actually doing, and you don't even need to know the actual news. You're going to see it beforehand by the way the money's moving.
That's what Prospero was built for, to really just do that and to bring the objectivity into it, because it's so easy to just be like, well, it doesn't make sense why these telecom stocks are moving decidedly, bearish. But sometimes, especially if it's a pattern among them, I don't think it's worth it. Like it only makes sense for those trends sometimes if there is bad news about to break. And like we were talking about that on the flip side with Alibaba, especially with something that looks like, picking up like these Chinese news events that may be being leaked to certain people in the know before they happen. And yeah, that's what Prospero was built for, to be able to have people go in and say like, wow, like, do I need to reevaluate? Do I need to trade more cautiously because of these dynamics that we're seeing in the institutional options markets? And yeah, I think that's a great point.
Good place to leave off for this week.
It's a great place.
All right. Another weekly update in the books, and we'll see everybody back next Monday, 11 a.m.